get to the direct listing. Good segue. Clearly, the biggest news of the week is Coinbase, the largest direct listing ever. Bill Gurley somewhere is smiling. And that's on top of Roblox, which I think was the second biggest. 2020 revenue, $1.2 billion.
Sorry, Brad, did Snowflake direct list, or that was a traditional IPO?
No, that was traditional IPO.
Traditional IPO.
I don't know who got their wet their beaks on this one. Sax, did you have a little bit?
I had a little tasty poo.
Little tasty poo. Ooh.
I had a lot showered upon me.
Explain, boys.
Because you're in Ribbit, right?
I was one of Mickey's largest LPs. Yeah.
Who's Mickey? One. For the audience who doesn't know.
Mickey Malka, who runs Ribbit Capital, who owns 7% or 10% or 7 or 8% of Coinbase. And what was incredible was I got distributed all of it yesterday. Which, by the way, I think for a direct listing, the strategy to me makes a lot of sense. I made a mistake in hindsight if I think about my distribution strategy, because myself, Excel, and Andreessen, when we did the Slack direct listing, we distributed probably 10%, and then we waited and then we trickled it out over time. But by definition, I think the price action on direct listings shows you that you top tick the top price at the moment on the open print. And so, if you're going to sell, you're probably better off selling absolutely right away. And if you look at the price action on direct listings, it's basically been one-way direction down from the point of the direct listing. Spotify did that for 2 years. It kind of languished. Slack did that until the Salesforce acquisition. So in general, I think if a direct listing happens, when you get distributed the stock, you should probably sell it right away. And
that means it was priced correctly as opposed to underpriced. Is that what we should take from that?
Well, no, because I think what's TBD is what is the morale hit to the company to see a one-way direction down in, a stairway down on the stock price. So maybe it was good for selling shareholders. It's not necessarily good for the morale of employees, which then could impact the long-term enterprise value that's being built at a company. So I think there's a bunch of TBDs. I do think that direct listings are administratively clean in some ways, but company building may not necessarily win.
But Chamath, you had a point of view, I think it was last year or 2 years ago, about how, and I read some papers that one of the analysts at Wall Street put out showing that there isn't much of a benefit to lockups with respect to short or long-term price volatility. Do you still hold that point of view?
I think lockups are really unfair because they're a tax on the people that have been there the longest, which are the employees. So, the idea that somebody that comes in at the absolute last minute, Brad and I have done a bunch of IPOs recently where you get allocations in a book. He and I had nothing to do with companies, but we get it shares and we sell it day one. Then there are people that have been in that company for 6, 7, 8, 9, 10 years who sit around, twiddling their thumbs, watching all these other people generate one day returns. There was a tweet that Bill Gurley had yesterday that says, there's a well-known crossover fund that over the last year has printed $1 billion of one-day share gains. Well, that's crazy. So I think that lockups are kind of a regressive tax on the people that do the work, and they are just rewarding people that have nothing to do with companies.
Brad, what did you do in Grab? Because you locked yourself up, right, for a couple of years, and is there a lockup for the existing shareholders in Grab?
Yeah. So first, I totally agree with Chamath. Lockups are one of the most insidious things I think about the traditional IPO process. The fact that DoorDash employees are sitting there watching the stock go from 100 to 200, and then, all these other folks are selling while they'll watch the stock go from 200 back to 100. I would think it's incredibly demoralizing. And here's the thing, it doesn't need to exist. In Roblox, there was no lockup. The employees were free to sell, but guess what? A lot of them chose not to sell. Right? It's fairer and quicker price discovery when you actually allow the supply and demand to exist in balance. So what we did at Grab was we fought hard for the most open, unlocked, right, day one we could possibly get. In that case, there are a lot of big shareholders who are on the board. So they're deemed affiliates under Section 16 of securities law. So they can't sell, right? They're deemed to be insiders, right? But we, at the end of the day, all employees can sell. There was a group of senior management that said, hey, we want to voluntarily lock as a signal to the market, but all other employees in the company can sell. So there are over 5,000 employees in the company. And all of the early shareholders can sell on day one. And I think this was the first time I've seen this in this alternative IPO. So we have almost a third of the entire share base of the company that is available for sale on day one.
Incredible. Hey, Brad, can I ask one more question? The economics for Grab, are they better under your structure than they would have been for a traditional IPO to get the same amount of capital, and they're paying 7% to the underwriting banks?
As we all know, Bill Gurley has laboriously pointed out and documented that there are two expenses to a traditional IPO, right? There's the upfront fee, 5.5%, 6%, whatever they're paying on the amount of capital raised. But he would argue the much bigger expense, right, is the indirect cost of the structural underpricing. Right. So in a traditional IPO, let's say you have a $10 billion enterprise value raising $1 billion. If it's being underpriced, he would argue structurally by 40%. We can all debate that, but that's $400 million of dilution to employees and to existing shareholders. I think everybody in the Grab process, both the buy side portfolio managers from Fidelity, Janus, T. Rowe, et cetera, as well as the company, believe that we got a 20 to 30% higher price than a bank would have got because of the conviction the portfolio's managers had as a result of the significant investment we were making in the company, as a result of the fact that we were locking up our promote shares or sponsor shares for 3 years. And so if you say it's 30% on a $4 billion raise, that's over $1 billion of savings, right? Over $1 billion of indirect cost savings to the employees and the shareholders. And for me, our North Star is founders. And so we literally have deconstructed the IPO at every step of the value chain. And to say, like Rich Barton, my thought partner in this, he's on the board of Netflix when it went public, took Zillow public, took Expedia public. And he said, we can make this better at every step of the value chain. And so we've thought about it like a product, and we build in a capital markets business that says part of it, right, is eliminating the commission. Part of it is getting a fairer price, but part of it is curating that day one cap table, right? Because these companies are stepping into the public markets. And, as Rich has said and others have said, think about all the curation that goes into a private cap table. Now, when you go public, Rich calls it a cap table randomization event, right? You lose total control over your cap table. Right. Whereas in the case of Grab, we hand selected what we think are the world's best public market shareholders to be their day one cap table. So it's a very different outcome. And it's not just about cost savings. It's not just about trying to get a fairer price. It's actually making the process better at each step of the value chain. All
right. So we were talking about Coinbase last year when they had a big brouhaha, and Brian Armstrong said, we are not going to talk about politics inside the company. You can have political views, but not inside the company. Sachs, you did some tweets about this. What are your thoughts?
Yeah, I mean, apparently, Coinbase's ban on politics in the workplace and their refusal to submit to New York Times interviews did not prevent them from creating an $85 billion company. I'm shocked that they were able to do that. That's basically what I tweeted. And, it just shows that founders can do things their own way. They don't have to submit to, the woke mob. And that's basically what I tweeted. And then, of course, it's been interesting to see the reactions. The first day, I got like 10,000 likes. And then the second day, it seemed like some sort of SOS went out. And now I've been sort of surrounded. There's been this outcry. And my takeaway is that the woke mob really doesn't like to be called out as a woke mob. And they're sort of surrounding me with pitchforks now, saying, "How dare you call us a mob?"
Sachs,